In America, almost no one sits you down and teaches you the rules of money. You pick them up by watching. Save, stay out of debt, max out the 401k, wait. But if that is the way to make money, then why is the divide so wide? The top 10% of American families now hold roughly 2/3 of all the wealth in the nation. Americans hold roughly $48 trillion in real estate wealth. The top fifth of earners hold 56% of it. That is a lot of wealth at the top, yet the bottom fifth hold only 5%. So the wealth divide is real, and there's a real difference between the moves that each side is making. The gap's not discipline. The gap is usually what you own. So today on Escape the Clock, we're aiming to answer the question, what happens when the rules you were handed were never the rules the wealthy were playing by? To answer this, I'll be joined by Freddie Rappina. He spent 20 years on the Fairfax County Police Department in Virginia and started noticing at 21, through his real estate broker, that the people quietly getting wealthy were doing things he had never read in a single personal finance book. He retired from the force, went into finance, and wrote the book that he wished he'd had. He is now a chartered financial consultant, an accredited investment fiduciary, the founder of Opta Financial, and the author of Playing the Wealth Game. So today, we get into where the line actually sits between debt that builds you and debt that buries you, how the wealthy turn assets into loans and loans into income without ever selling or paying the tax, and why your own advisor may never bring any of this up. So stay tuned to find out which game you've been playing this whole time and what it takes to switch, win, and escape the clock. Welcome back to Escape the Clock, the show where we highlight strategies and approaches for achieving financial freedom and having the option not to work. I'm your host, Daniel C. Rogers. If you're working toward financial freedom, then you're likely aware of the standard playbook. Grind hard in your working years, keep your debt low, maximize your retirement accounts best when you can, build a balance, and guard it the day the paycheck stops. There is nothing inherently wrong with that path. It can work well if you live a disciplined life, make smart moves, and avoid the big mistakes. I mostly followed that path myself. I eliminated over $100,000 of student loan debt, then $15,000 of consumer debt, paid for cars and other big ticket items in cash. I tracked my spending and avoided lifestyle creep, and I budgeted for trips. I refinanced mortgages. I took advantage of deals and programs. Most importantly, I made career moves to raise my W-2 income, maxed out my retirement contributions, and invested whatever I could. It's the slow and steady way to wealth. And given enough time, it can work for almost anyone. To get into the top 10% of American households, you now need a net worth of about $1.9 million. The average American household is worth more than $1 million. The typical family, sitting right in the middle, has about $193,000. So if the typical family who is maxing out 401ks and working hard stuck around $193,000, how is the top 10% pulling so far ahead? The truth is that they're playing chess while others are playing checkers. Instead of relying on a W-2 paycheck alone, they let their assets grow and then they borrow against them. Then they turn around and use that money to buy things that pay them back. It's an entirely different game, a different set of rules. Most money advice, including a lot of mine, is about building that balance and then drawing it down slowly so it lasts. But that isn't the only way to do it. So today, I'm joined by a guest who can explain this game to us, and most importantly, how to win at it. Freddie Rappina spent the first part of his career in law enforcement, retiring from the Fairfax County Police Department in Virginia before moving into finance. Now he's a wealth advisor, chartered financial consultant, and an accredited investment fiduciary, the founder of Opta Financial, and the author of Playing the Wealth Game. He manages tens of millions of dollars for his clients, and he works with people who are done playing it safe and wants to start playing to win. Freddie, welcome to Escape the Clock.
Thanks, Dan. Thanks for having me.
Take us back to the moment it clicked for you that there were actually these two different games being played with money. Curious, what did you see on the job or even early in finance that made you wanted to teach people that nobody is just going to hand them an easy path to what they need?
Yeah, I would say it was when I started getting around more wealthy people. Started with my real estate broker when I was 21 years old. And I started to realize that a lot of the things they talk about or the strategies they implement were not the same strategies that I was reading in personal finance books or even going through courses or any of the typical advice or knowledge at the time. But I didn't want to say later on down the road that something was right or wrong. I realized that these were two completely different games and there were choices to be made. But I wanted people to understand that there were two different games. So I came up with this chess and checkers analogy to make it easier for people to understand.
Ramsey Solutions had done a study that showed that 70% of millionaires built their wealth primarily through just workplace retirement plans. And most never earned a six-figure salary. So there does seem to be these games there. And it's interesting how you kind of point out that there are these two different games and that people who play by them have very different outcomes. So I'm curious, can you go a little deeper? What does a chess player, for instance, understand about money that the checkers player never really figures out?
Well, first off, I just want to start by saying there's nothing wrong with playing checkers at all. You can live a great life. You can retire. You can be happy, which is the most important thing, in my opinion. But I don't believe that you can build mass fortune playing checkers. For that, you will likely need to switch over to chess. And the biggest differentiator that is going to separate a chess player from a checkers player is their attitude towards debt. In my opinion, that is the biggest factor. Like I said, it's an attitude. If you're playing checkers, you want to be completely out of debt, funding those retirement accounts, doing all the strategies that are really good to win a good checkers game, draw down from those assets later on in life, have compound interest do its thing over a long period of time. If you're playing chess, you want to get in as much debt as possible without over leveraging. And that's the important part of chess, because you can screw up chess too. It's not a highway with no one on it. You can mess it up too, especially by over leveraging. But it's two different games. But chess does have the potential for growing significant wealth, especially a lot more quickly, in my opinion, than checkers can. Compound interest is great. It's math. I'm not going to try to disprove compound interest, which is fact. But what I do say is that people don't live long enough for compound interest to work the way most people would like it to. I say the joke in my book, if you live 900 years like Yoda lived, compound interest would work great. By your 400th year, you're good. But here in this galaxy, in this lifetime, it just takes too long, especially if you didn't start out with a whole lot for compound interest to get you to a lifestyle that some people want. If that's the case, you need to start looking at chess.
Yeah, I'm sure a lot of people here who are chasing an FI number is interested in making a substantial amount to maintain the lifestyle they have. I know a lot of wealth advisors will say, oh, okay, let's get you to 60% of what you're used to. And that's not what anyone really wants, right? You want to maintain the lifestyle that you're comfortable with, or maybe even expand it because you have more time to do things once you're, either in an early retirement or just done with work. So curious if you could go a little bit deeper into the ceiling on people who only play checkers, or doing kind of these traditional slow retirement account paths. Is the ceiling kind of based on just how much they're able to save in those accounts? What's really going to limit them there?
What's going to limit them is how much discretionary income they're going to be able to put in that account. And I would say one of the bigger things is what's their attitude towards saving for this future, right? So there's this graduation mentality to checkers, this one day mentality where in the future, I'm going to have this and it's worth all the sacrifices I'm making now. And that is a conscious decision that they're making, or sometimes even subconscious decision they're making playing checkers. Whereas chess is a lot more focused on, I want to enjoy myself now and in the future, right? Not sacrificing the future for now. That's a bad play, but developing income strategies that's going to have a good lifestyle now, but also be able to keep a good lifestyle in the future.
Did you see different perspectives in the 20 years you were a police officer versus when you started being a financial advisor? Like in particular, were you surprised about how wealthy people behaved with money differently than other people? Just curious what insights led you to some of these conclusions.
I did. The people who are wealthy understand the game and they understand taxes. middle class that feels like it's getting squeezed all the time. And, it's hard to argue with that. They see taxes as like an enemy, a foe, or, an opponent. Whereas the wealthy chess players, they see the tax code as a complete ally, like a guidebook where they're able to strategically map out how they are going to accumulate more wealth and more income by using the tax code to their advantage. And when it comes to the tax code, if people just take a step back and think about why there's a tax code in general, things start to make a little more sense. There's tax codes and tax breaks and tax benefits in a lot of different ways. But if you think about it, every one of those ways are a mutually beneficial point. It's a mutually beneficial relationship between the citizen and the government. If you do what the government wants you to do with your money, how you invest it and how you grow it, you don't pay a lot of tax in the United States. But it's a free country. If you don't do any of those things that the government lays out in that massive tax code, it's free will, but they are going to then take what they need to, because they still need to build roads, bridges, and schools and everything else. So understanding why there's a tax break and have your understanding of why is tax break for businesses, why are there tax breaks for real estate, why are there tax breaks for even having kids, your attitude can quickly become more positive towards the tax codes.
Someone who's listening right now and trying to figure out what even game they're playing, they need to look down at the board. It's really interesting to think about taxes, think about borrowing. These are two different aspects. What's something you might say to someone who might feel like they're being somewhat successful, but they're worried that maybe they're stalling because they're not playing the right game? What's the first clue that you usually give people to help them realize what they're doing?
Well, it's goals, right? So if their goal is to be comfortable, their goal is to retire, they will want to have X amount of dollars a year to go see their grandkids, and they want to have all those like buckets in mind, then a checkers game is going to be fine for them, right? And if you're going to play checkers, I want you to win checkers. Nothing sucks more than being a bad checkers player. Capitalism will run you over if you're a bad checkers player. But you shouldn't be shouting at the moon anymore. Why do the rich keep getting richer and others not, right? So you are playing checkers. It is going to have limitations on the type of things you can do. But if you're happy doing that, by all means, go right ahead. So like I said, I never wanted to say the strategies are right or wrong, or some financial pundit is right or wrong. I just say it's checkers or chess and understanding which one. That's why the book I wrote, Playing the Wealth Game, was designed to be more of a self-discovery book. So reading the book, people should understand by the end of it whether they are a chess player or a checkers player at heart. And if they're a chess player and they are playing checkers and want to switch, well, that gives them some strategies and some resources to do that. But we have a lot of checkers financial advisors out there who don't want their clients even thinking about chess moves, and they are not a chess player themselves. And that could be a bad dynamic for people who are chess player at heart. For checker people, it could be absolutely fine.
Yeah, that makes a lot of sense. And I'll admit, I think I was mostly a checkers player myself. And I think when I write about strategies, they're the ones that I know worked for me. And so they are very like, how do you win at checkers? And I think I've evolved a bit. I am playing more of a chess game nowadays, but my risk profile has changed. Mm-hmm. And I do think risk can kind of change which game you're feeling comfortable playing, your capacity and things like that. But let's get into chess for a minute, because I think we cover checkers a lot on this show and we've touched chess a little bit. So I want to talk about debt first, because I think the line between debt that hurts people and helps people is really interesting, because Americans now owe a record $1.28 trillion on credit cards, which has an average rate of 22%. That's roughly 3 times a typical mortgage rate. It really buries quite a large number of people, and they can't help but see it as a bad thing. Where do you see the line between debt that builds wealth and the debt that buries you?
Yeah. So the debt you're talking about, consumer debt, is not what I'm talking about when I refer to debt at all. We're not talking about running your credit card up or living a lifestyle that's not conducive to the finances. What I am talking about is once you have a good foothold, you have even a good checkers game going, right? And you have the accounts, you have the assets. Now you can start taking out loans. You can start leveraging, and not just taking out loans, but using the loan to purchase a cash flowing asset, such as a business, such as a piece of real estate, something that's going to create income and also has tax breaks. Some of it goes into your pocket so you can enjoy life now. In my case, travel baseball and travel cheerleading, because that's what my kids do, right? And I'm spending a whole lot of money on that during this decade. And I enjoy the heck out of it because one day it's going to end and I'm going to be bored. But having that enjoyment now while still building income streams for future as well, and having the asset pay back the loan, being able to service that loan, have it not come from your assets, allowing your assets to grow, and you don't create a taxable event with needing to sell the assets to create the income to enjoy your life. It's almost like a flywheel where you have the assets, you take out the loan, you buy the cash flow, real estate or business, put some of that money back into the account, let that grow. Some of it, enjoy your life with. So it's just a different way of doing it. But the right expectation has to be there and the right circumstance. Can't walk into a bank and say, I don't have any money, but I want to get a loan. That's not going to work.
So it sounds like in chess, a strong move would be using your money or your leverage to make more money, because the assets that you're acquiring are able to produce new income streams for you, and potentially even at some point maybe replaces your W-2 income.
That's correct. Yes.
Can you give us a couple examples, though, for someone who hasn't gotten to that point yet? Maybe they're starting out, they still have their primary job. What does income producing debt look like for an ordinary person who's just kind of getting started with the game?
The ordinary person, like in what I'm gathering from your hypothetical, is someone who's starting out, has W-2 income job. They need to save. In my opinion, start saving, but understanding that the money that they save is by itself is likely not going to lead them to the promised land. It is getting to the point where they're able to plop that statement down in front of a lender to be able to get the loan. So it's not just a right away thing. Sometimes it takes a while. Sometimes it takes years. But I think it takes as many years or as much time as people think it does. And so, yeah, it's just a function of being able to be disciplined in the beginning and play a good checkers game, knowing that you are going to switch over to chess at a later time.
Yeah, it's like, progress far enough to evolve to that game and then be ready to be able to play it well. That's great. Can you talk a little bit about debt that might look productive, but could actually be troublesome from a client, red flags? And like, for instance, taking money out of your home, using equity, is that good leverage or bad leverage? Is there certain rates people should avoid? Like, what types of things have you learned that can help people avoid mistakes?
So taking like a home equity line of credit or something like that out on your home and not using to buy an income producing asset, like using it as like a credit card where you're going on vacations and you're buying boats and jet skis and all that. And using your W-2 income to pay the home equity line of credit back. That's probably not a very good strategy at all, right? But using a home equity line of credit to purchase a small rental property somewhere can be a good use of the HELOC if other things are in order, right? So again, you not over leveraging, you should have reserves to be able to weather storms, because storms are coming. They happen, whether you're buying businesses, you're buying real estate. It's not all rainbows when it comes to owning that kind of stuff. You have tenants who don't pay rent. You have businesses that don't do well some months, and you have to be able to withstand that. Otherwise, you're just playing a big, massive game of Jenga, and sooner or later, you're going to pull the wrong piece.
And the wealthy are doing this, right? There was this Washington Center for Equitable Growth study in 2024 that actually showed that $175 billion in loans were given from big banks to wealthy clients for their investment portfolios. And all of that was shown because they were looking to raise cash without selling and without triggering taxes. So it's very strategic. How can someone think about borrowing against something they own rather than just selling something they own just to generate cash? How do you start thinking about that strategically?
Yeah, so I want people to think on a scale, because when people think about these strategies, they automatically start thinking about like big names, big net worths, Elon Musk, Jeff Bezos, you name the person, right? And the way I explain this is that my son plays high school baseball right now. He plays on one of the best teams in Florida for his age group. He's being looked at, all that kind of stuff. But it's still 15U baseball. He doesn't play for the Tampa Bay Rays. He doesn't play for the New York Yankees. But the strategies that he uses to play 15U baseball are the same strategies that the major league players use. There's not a different correct way to field a ground ball or whatever, right? So the strategy is the same. It's just the scale is different. So let's move that type of idea over to finance where, yeah, you might be playing Little League right now in finance, but if you're playing with the same strategies of the wealthy, you can get the scale bigger as you progress. It's just having that mentality that it's not going to happen all at once that I think a lot of people have a hard time getting over. And then they just throw up their hands and like, well, I'm just going to play checkers. And that's fine if that's what they want. But I just want people to understand that the game is available to everyone. It's just, do you want to play it or not?
A lot of people will think about either taking this money to maybe start a business, get into real estate, or make a big investment of some type. Mm-hmm. Why does the financial industry steer so many people away from real estate? It seems to be such a big moneymaker for so many, yet almost every financial advisor doesn't even want to talk about it.
Yeah, it frustrates the absolute heck out of me. I feel like a unicorn in this industry sometimes, talking about real estate, talking about businesses, talking about things that make me absolutely no money. A lot of advisors, they're afraid of losing the assets under management. Let's not sugarcoat that. So if you're buying $1 million property and you're putting $200,000 down on it, that $200,000 is leaving our accounts. And we encourage that, by the way, if it's the right thing for them. But, that $200,000 has got to go. But a lot of people don't like that. They think it's risky. And a lot of financial advisors are not chess players. They are checkers players. And they think in checkers terms, and they have their own biases or fears even. And it's usually not malicious. It's just how they are, how they're advising. And so people should work with an advisor who fits them. If they are a checkers player, they should work with a great checkers advisor. If they are a chess player, they should work with a great chess advisor. So the information is going to be applicable to them.
It's kind of drove me crazy because I had many advisors in my time, but I remember talking to one of them and saying I wanted to get a second property because I wanted to rent it out to my son because it would save me a bunch of money for his college. I wouldn't have to save as much in 529 because I'd be able to get rental income from a condo in a university district that would have a lot of students coming through. Eventually, I'd be able to get them rent-free access to that. And they're always talking about diversify, and that would really diversify. Yeah, they're like, no, don't. They were trying to give me all these reasons not to do it. And a lot of it was tax reasons and this and that or whatnot. Eventually, I did it. And I have to say it was really a great decision. I'm really happy I made that move. And I've decided since then, like with my primary residence, when we move out of there, I'm not going to just sell it. Like we'll rent that as well. And I'll continue to try to get more doors as we go. And there's many different ways you can kind of enter into real estate in your plan when you're ready to do so. I am wondering how you help people with this, though, who are interested in getting into real estate, aren't used to having an advisor who's willing to talk to them about it and isn't even sure how much cash they even really need to start with and what types of properties are reasonable and, if they should be working with property managers. Like, what is the way for someone to get their head wrapped in a space that so often is just avoided?
Yeah, it's really about understanding what they want and going over each option with them if they're interested in, like, let's say real estate, right? It's going over which of these options is going to help them be able to sleep at night, right? Because if they're not able to sleep at night, not a good idea. And also just getting them in the mental state of building wealth, doing what they do, right? When we talk about scale, think about companies. Think about financial companies. You have financial advisors telling people not to invest in real estate or businesses. Meanwhile, the financial company that they work for owns an absolute ton of real estate and businesses, as well as market-based assets too. So, I don't have to go any further than life insurance companies. That's my biggest, it's not a gripe. It's just like one that opens people's eyes, right? We had a massive life-threatening pandemic. How many life insurance companies went down during COVID? None. Not only did none of them go down, the top three had some of the best years they've ever had in 2020, 21, and 22. Like, how does that make sense? Like, how can what you insure be deteriorating and you're up? Like, that doesn't make any sense. You don't have to be a financial anything to understand that concept. But I'm not saying they did anything wrong. They're doing things right. They're purchasing shopping malls and hotels and big apartment buildings and other types of businesses and using that income to pay out the claims and everything else. It goes into general fund and everything that they have, they're able to pay out COVID was a BB at a freight train. It's just not affecting them. But how many of their advisors are talking about these types of strategies? So it's really about understanding what do you want and what are they doing, right? What are the investment companies who produce mutual funds? What are they doing with the money? Are they just sitting on it and putting in a money market account for 30 years? Or are they investing in it into real estate and other business as well? So you don't have to go very far to understand that there's a lot of do as I say, not as I do in the financial world, where they want to take people's money and then they turn around and tell them to play checkers while they turn around and play chess with it. And that doesn't mean the advice is wrong as long as it's to a checkers player. Checkers players should be doing checkers things. But if you're a chess player, then doing what the proverbial they do could be more beneficial for you.
It's like do as the wealthy do, not what everyone is just saying.
Right. Yeah. There's almost like a paternalistic element to the industry right now, which is bothersome, where it's, oh, chess would be too difficult for you. It's too risky for you. Leave chess to the adults and just hand over your money and we'll let it sit in compound interest 30 years and whatever. Right. Meanwhile, they're beating me out on real estate deals and everything else with the money that I took from clients and put into their funds. Right. So, but it's not evil. I have to say it's not coming from an evil place. It's coming from uninformed and people just believing that checkers is the only route. And we know this instinctively. One of my jokes I say in seminars, especially here in Tampa, is I say, go down to the boat show and walk up to somebody with a $25 million yacht and ask them how they got it. And call me if they say, I fully funded my 401k and that's how I got this $25 million yacht. Not going to happen, right? But checkers is pounded into, especially the middle class, and not giving them the resources or the education to play chess or even think about playing chess. So I really want to have people understand that there are two games, and yes, you can play either depending on what you want.
This has been really eye-opening. I love the way you put it. I think it's really helpful for people to realize that there's a lot more mileage they can go, right? You can master one game and then you can kind of approach the board and learn from how other people are playing it. So for folks who are looking for help on this or just really interested to learn more, how can they connect with you? And also, how can they find your book, Playing Out the Wealth Game?
Well, the book, Playing the Wealth Game, they can find on Amazon. It's on paperback, it's ebook, it's on Audible. And I really don't care which way that they get that information. If they want to listen to it on Audible, feel free. You have to sell a Harry Potter amount of books on Amazon anyway to really make anything. I want people to have the information. I want them to really get the message. And if they want to reach out to me or the firm, they can just go to optafinancial.com and schedule a consultation and we can talk and see if we are a good fit for them.
Fantastic. Well, thank you so much, Freddie, for coming on the show, and best of luck playing the game.
Thanks, Dan. I appreciate it.
In the United States, it's rare for someone to sit you down and teach you the rules of money, let alone how to win the game. So we absorb the rules by watching others through trial and error. Imagine trying to play a card game for money and not knowing the rules. Others would constantly be taking the pot, and you'd be there feeding it, frustrated that you're doing what you think you're supposed to be doing, but falling further and further behind. And that's just how the financial system works in America today. Take borrowing, for example. Two people each borrow $40,000. The first one finances a new truck. The payment comes out of his paycheck every month for 6 years. The truck loses value the day he drives it home. And when the loan is finally gone, so is most of the asset. The second one takes a line of credit against the equity in her home and puts it into a small rental. The tenant makes the payment, not the owner's W-2 paycheck. The property is worth more in 6 years than it was the first day, and she still owns the equity that she borrowed against it. So same $40,000, same interest. One of them bought a liability and paid for it with their life, and the other bought an asset and had it pay for itself. Nobody really teaches that difference. We're just told debt is bad. Look no further at how the wealthiest are playing the game. At the end of 2025, U.S. insurance companies held $868 billion in mortgage loans. Life insurance companies accounted for 96% of that. Freddie made this point better than any chart could. He asked how many life insurance companies went under during COVID. The answer was none. And the largest ones had some of the very best years they'd ever had. While most of us were worried about our loved ones and whether the government would compensate us for our inability to clock in, one of the wealthiest sectors in America was leaning into the opportunity to expand the wealth that they had already accumulated. So how do you play the game well? Well, first you have to know which game you're playing and if you want to continue to play it or not. Freddie calls these money games checkers and chess. Checkers is the traditional path that most of us are told to take. Avoid debt, save 15% of what you make, hold 3 to 6 months of your cost of living in reserve, take that 401k match and buy that index fund and don't touch it for 30 years. Honestly, it's a game I play very well and the one that I teach you how to win and escape the clock. And you can win it, but it's the slow and steady path to wealth. And for many, that's comfortable. But not playing it is actually quite dangerous. At the end of 2025, the median 401k balance is only $103,202 for those age 65 and older. The median 401k balance, a little over $100,000 for those who are 65 and older. So imagine finishing the game, entering retirement with only $100,000 to live off of. For many people, they won't even make it a single year. That is losing. And sadly, it's what the average person is doing in the United States. And most financial advisors, they teach the rules of checkers, and for a price, they'll even play the game for you. Fiduciaries are legally bound to manage your assets with your best interest in mind. And it's worth sitting with why that even needs to exist. I mean, do we require a mechanic to take an oath before they look at our car? Maybe they should, but still, the point is that the financial advisors hold a lot of power. But in my mind, the real reason that fiduciaries exist at all is because the role has a natural conflict of interest in it. There are a few ways that financial advisors can get paid. And one of the most popular is to take an annual percent of what is called assets under management, or AUM. In other words, the more wealth that you have, the more they're getting paid. It actually sounds great because it sounds like they have this incentive to grow your money in order to make more money for themselves. But think for a moment where it falls short. Let's say you run the numbers and a rental property could reasonably return 12% on $250,000, while the mutual funds that your advisors put you in is returning around 6.5%. What do you think the advisor would advise? They say you should keep it in the mutual fund because the alternative is that $250,000 would leave their management. Now, a good fiduciary should do the right thing here, but no one is more biased for your results than you are. And as Freddie said so well, many of them are checker players themselves. There's nothing wrong with that, but you'll want to pick one that knows they are a checkers player and that you trust to help you win the game if you want to continue to play it. The worst is what he called paternalism. When the advisor says that chess is too complicated for you, that it's too risky for you, leave chess to the adults, hand over the money, and we'll just take it from here. I had that experience myself. I had made a case where I'd move $300,000 to buy a condo in a university district. I had calculated the return rates and I was excited about the new diversification. I even showed my advisor how much time it was going to shave off my son's 529 savings goals, allowing me to redirect that cash elsewhere. And my advisor, he tried to talk me out of it. That $300,000 meant selling stocks, and that meant paying taxes. But taxes can be budgeted for like anything else. And in the long term, the ROI made a lot of sense to me. So I made the call, and I ultimately moved on from that advisor simply because I had moved on to chess and he was still playing checkers. Financial chess, it can feel like this intimidating game to those who haven't been introduced to it. But like anything, it can be learned and it can be mastered. So let me explain it a bit at a high level, because knowing the difference is the first task in your plan. First, you build assets, and not any old assets, but ones that you've researched that can provide back some cash flow. This could be real estate, it could be a small business, royalties, or even stocks that you could write options against. There's a long list, and I've actually covered a lot of these on the show already. But when you buy them, you're not looking to sell them. You're looking to pump them for cash. And there are a few chess moves worth understanding on this. First, you can make standard moves. These are things like collecting the premiums on the covered calls, or just generating rental income, or just growing your business's profits. It's the normal passive income stuff that we've covered quite a bit and that I cover extensively in my book. Now, that's playing the game, but according to Freddie, there's a more advanced moves that can really help you win. To make those moves, you'll be doing things that you never consider doing in checkers. First is borrowing against the assets. You take the borrowed money and then you buy something that produces income. Another rental, maybe seed money for a new business, bank notes, or maybe capital that you could lend out for a return. That income does two jobs at once. It services the loan, and it puts money in your pocket to spend on your life right now. And when you see a chess player, you'll know it. They amass more assets, they rarely sell, and they grow their wealth without triggering tax bills. Freddie called it a flywheel, and that's exactly the right word for it, because every turn adds a little more. When the advisor used taxes as the reason for me not to make my real estate move and buy that condo asset, he was actually going by the book. The middle class treats taxes like an opponent, whereas the wealthy treat the tax code like a guidebook. Think about it. There's a reason there are breaks for owning a business and owning real estate or even having kids. The government's telling you in writing what it wants you to do with your money. And most people, they never read the instructions and then they feel cheated by the outcome. Now, I'm not trying to sell anyone on chess here, not at all. The goal is to know which game you're playing so you can do well at it. Because you can lose either game, but losing at chess is much worse than losing at checkers. And you can think of it this way. In checkers, the worst you can do is lose what you put into it. So put $5,000 into a bad investment and you're out $5,000. It stings, but it's over. In chess, it doesn't end there. Borrow against your home to buy the wrong property, and the loss keeps going even after the asset's gone. The tenant leaves or the value drops. That payment that you owe, it still shows up every month. And this is how people lose a house. Freddie said if you're careless with leverage, you're playing a giant game of Jenga, and sooner or later, you're going to pull the wrong piece. And as always, mitigations are key. Storms are always on the horizon, so knowing what to do when they hit will make all the difference. We've covered it before on the show, but many people already have an asset they don't realize, and which is their home. We build equity in our house without even really thinking that we can pull it back out. But a good chess player will recognize that piece on the board and know when to move it. And when moved well, it opens up new pieces and new moves. Do it badly, you might lose that piece. And yes, maybe your house. Those are the games. The first task is to identify which one you're playing and if you want to switch or not. If there's one thing to take away from this episode, let it be this. Playing checkers well is the slow and steady way to financial freedom. Playing chess is the path hidden in plain sight to build significant wealth. Know your goal, master the rules, and play to win. I'd love to hear from you. Which game are you playing right now? And is it the one you chose or were you handed? Email me at contact@escapetheclock.com or leave a comment wherever you listen. I'm Daniel C. Rogers. Thanks for listening and best of luck making your next move and escaping the clock. I'll catch you next week. That's a wrap on this episode of Escape the Clock. Everything you've heard today is for educational purposes only, designed to help you think, plan, and build a stronger financial program. Take what resonates, bring it into your Escape the Clock plan, and review it with a qualified professional before making any major moves. I'm Daniel C. Rogers, a wealth management certified professional and your host. The book, the free planner, and the one-on-one time with me are all waiting for you at escapetheclock.com. If this episode was valuable, please leave a rating, share it with someone who needs to hear it. I'll catch you next week.